Hi, Assalamualaikum. So we go to the final paper ACC 2121 semester 1 2022/2023. So we go first to the question 1. Okay, the first subcom question for the question 1 is compute the indicate ratio for berkat usaha sendan berhad. Okay, so for the first ratio is current ratio. To find current ratio is current assets divided to current liabilities. So we got 1.94 times. So the second ratio is account receivable turnover. To find the account receivable turnover is sales multiplied with average account receivables. So we got 9.46 times. After we got 9.46, we divide with 365 days, divide to 9.46, so we got 38.58, or we round up to 39th day. Okay, third ratio is inventory turnover. To find inventory turnover is COGS divide to inventory. So we got 5.75 times. And next is total asset turnover. To find total asset turnover is sales divide to total asset. So we got is 1.67 times. And then we go to net profit margin. To find the net profit margin is net income after tax divided to sales. So we got 0.907%, or we round out to 0.91%. Then the sixth ratio is return on total asset. Okay, to find the return on total asset is net income after tax divide to total asset. So we got 1.51%. And next, to find the return on equity is net income after tax divide to ordinary shares. So we got 4.05%. And lastly, total debt or total assets. How to find it is by total liabilities divide to total asset. So we got 62.69%. So, okay, next we move on to the question, still a question one by subcom, the next subcom question. Okay, construct the extended two-point equation for both berkat usaha sendan berhad and the industry. Okay, for two-point formula is net profit margin multiplied with total asset turnover and multiplied with equity multiplier. Okay, for two-point berkat usaha, the net profit margin is 0.91%, and for total asset turnover is 1.67 times, and multiply with equity multiplier 2.68. So the answer for Dupont berkat usaha is 4.05%. Okay, for Dupont industry average, they do not use total, they don't have the total asset and total equity. So I use the formula 1/1 minus with total debt. Okay. So for the net profit margin, DuPont industry average is 1.2%, and total asset turnover is 3 times. And I multiply with the 1 divide to 1 minus 60%. So for DuPont industry average, I got the 9%. Okay, moving on to the next sub-question for question 1. Evaluate berkat usaha strength and weaknesses as revealed by the analysis in A and B above. Berkat usaha exhibits several strengths and weaknesses in its financial performance based on the analysis of key ratio. On the positive side, the company maintains a current ratio of 1.94 times, reflecting good short-term liquidity, although it slightly trailed the industry average of 2 times. The inventory turnover of 5.75 times, though slightly below industry standard, suggests effective inventory management. However, weakness emerged in areas such as account receivable turnover, which at 39th day indicates a slower collection of receivable compared to the industry average of 39 days. of 35 days, potentially signaling inefficiency in credit policy of challenge in prompt payment collection. The total asset turnover of 1.67 times reveal potential inefficiency in asset utilization, as it falls short of the industry average of 3 times. A net profit margin of 0.91% is below the industry average, pointing to lower profitability, and an ROA of 1.51% indicate less efficient use of assets to generate profit compared to the industry average of 1.6%. The ROE of 4.05% suggests a lower return on equity for shareholder compared to the industry average of 9%, indicate potential challenge in generating profit from shareholder investment. Lastly, with debt ratio of 63% after we run out, the company carries a higher level of debt relative to total assets compared to industry average of 60%, suggesting increased financial risk and potential challenge in debt management. Overall, while Berkat Usaha demonstrates strength in liquidity and inventory management, address weakness in accounts receivable turnover, asset utilization, profitability, and debt management is crucial for sustained financial health and improved shareholder returns. Okay, now last sub question for question one. Suppose Berkat Usaha had doubled its sale as well as its inventory, account receivable, and ordinary share during 2021 without any further competition. Explain how will that information affect the validity of your ratio analysis. Okay, the question also give the hint. Think about average and the effect of rapid growth on ratio if average are not used. Okay, my answer or my opinion, if Berkat Usaha were to double its sales, inventory, account receivable, and ordinary share without adjusting for average, it will significantly impact the validity of ratio analysis. Financial ratio rely on average to provide a more accurate picture of company's performance over time. Without average, liquidity ratio, efficiency ratio, profitability ratio, debt ratio, and total asset turnover could all be distorted. The doubling of key financial elements might misrepresent the company liquidity, operational efficiency, profitability, leverage, and asset utilization. In summary, rapid and unadjusted growth can lead to inaccurate financial ratio. Emphasize the need of average and careful consideration when interpreting statements during periods of significant expansion.
Moving on to the second question. This question said that you have recently completed business finance course and would like to consider investing money. You are evaluating an investment in ordinary shares of two companies, which are company ABC and company XYZ. You have collected the following information on the shares of the two companies. So the table gives us the expected return for the ordinary share of the two companies and also their standard deviation, and the correlation coefficient for the both company are the same, which is 0.4. So the first question, if you invest half your money in each of the two companies' shares, compute the expected return and standard deviation of the investment portfolio. So when we calculating the expected rate of return, we noted that the shares will be on half. So 0.5 times with 15 of the expected return for the company ABC plus with the 0.5 times with 10, which is the expected return for the company XYZ. So the expected return for the portfolio will be 12.5%. For the standard deviation, when we calculate it using the formula, we will get the standard deviation for the portfolio is 77.07%. Therefore, the expected return for the portfolio is 12.5% and the standard deviation is 77.07%. For the next question, question B, the question asks us to explain the relationship between correlation and risk and return of the portfolio. The correlation between two assets in a portfolio affects the risk and return of the portfolio. If the correlation is positive, the risk of the portfolio increases because the assets tend to move in the same direction, which means that if one asset loses value, the other asset is likely to lose value as well. On the other hand, if the correlation is negative, the risk of the portfolio decreases because the assets tend to move in opposite directions, which means that if one asset loses value, the other asset is likely to gain value. For the next question, question C, the question states your decision supported with evidence and justification as to whether to invest equally in both company or to invest all money only in company ABC. So my answer is I should only invest in company ABC. Why? Because the reason for this is that the projected return of business ABC exceeds the expected return of both company when combined equally. As a result, this demonstrates that the company ABC provides a higher return to investors than when both firms join equally. Furthermore, the standard deviation of business ABC exceeds the standard deviation of both companies when pooled evenly. As a result, the investment risk is compensated by its higher return. For the last sub question, the question said that your father just learned from his financial advisor that his investment portfolio has a beta of 1.80. He requested you to explain to him what this means. Specifically, describe what you expect to happen to the value of his investment fund if the following were to occur. For this question, we need to stress that for every 1% change in market portfolio, the retirement portfolio would change by 1.80%. So the first moment, the value of the market rises by the 8%. So 1.8 times with 8%, we will get the change is 14.40%. So if the value of the market portfolio rises by the 8%, then the value of my father's retirement fund should only increase by 8% times with 1.80% equal to 14.40%. For the second moment, the value of the market drops by 8%. So when we drop the market by 8%, the value will be 1.8 times with 8%, we will get negative 14.40%. This means that if the value of the market portfolio drops by 8%, then the value of my father's retirement fund should decrease by 14.40%. Next question, 3 Roman, is your father's investment portfolio more or less risky than the market portfolio? Explain. My answer is my father's retirement portfolio is risky than the market portfolio because his retirement portfolio beta or systematic risk is higher than the market portfolio beta, which is 1.8 is higher than 1. If the market increases or decreases, his portfolio are expected to be increased or decreased by 180% of the market's change. The beta of the portfolio often represents its volatility in contrast to the market. A higher beta indicates greater volatility and risk. For the last moment, fourth moment, discuss the key insight of capital asset pricing model to your father. The capital asset pricing model, CAPM, is a financial framework that uses beta, risk-free rate, and market risk premium. This model consists of two parts, which are the risk-free rate and the risk premium. The risk-free rate is the potential rate of return on an investment that has no risk. Meanwhile, for the risk premium is the investment return that an asset is estimated to provide over the risk-free rate of a return. So, CAPM also has various drawbacks, such as it is based on historical data. And lastly, the CAPM implies that the market are efficient, which is impossible to achieve in real life.
On to question 3, Basis Sdn Bhd with a 25% tax rate and 50% discount rate. Consider a new automated press for its automobile scrap operation. The new machine required 2 fewer employees, reducing labor costs. It also lowered annual defect costs from 70,000 to 20,000. However, it has higher maintenance fees of Rm 60,000 compared to 20,000 for the older press. The decision hinge on evaluating this factor for financial impact. A. Using the cash flow estimation for replacement analysis. So the cost of new machine is 400,000, MV of old truck is 150,000, tax effect is 12,500, Total net initial investment is 262,500. After tax increase will be explained in the next slides. Depreciation for new and old equipment is the cost of per machine divided with 5 years. Tax saving from depreciation is the change of depreciation multiplied with tax rate, which is 25%. Total up will get the net operating cash flow. MV for new equipment is given 50,000 and tax rate is 12,500. Net relevant cash flow is 262,500 for first year, and second to fourth year is 100,000, 2,500. And fifth year is 100,000 and 40,000. These are the working. For working 1, 150,000 minus by 100,000 times 25%. For working 2, after tax is the total cost of old minus new machine times 25%.
Move to the question 3, part B. We need to evaluate whether besi sendirian Berhad should replace its old machine with the new machine by using net present value and internal rate of return methods. So, we need to plug in the previous answer into CFJ button, or we call it as stores cash flows in financial calculator, which is the net relevant cash flow and includes the interest 15% of discount rate. So we got the net present value of 99,740.03. Since the net present value is 99,740.03 more than 0, the project can be accepted. Besi sendirian Berhad should replace the machine. For the internal rate of return method, we just continue press shift IRR per year in financial calculator and we got 29.47%. Since 29.47% is more than 15%, the company should replace the new one. For the question 3 part C, we need to explain opportunity cost by using an example and describe how should they affect an investment cash flow. So opportunity cost in investment decisions involve the potential benefits foregone by choosing one alternative over another. In the case of besi sendirian Berhad, decision to replace its old press with a new one, opportunity costs are evident in various aspects. For instance, the automation of the new machine reduces employee costs, but the opportunity cost lies in the potential gains from employing the two fewer workers elsewhere or utilizing the saved expenses for other business purposes. The decision also involves a trade-off between higher maintenance costs for the new machine and potential savings that could have been achieved by maintaining the old press. Additionally, the new machine's ability to reduce annual defect costs presents an opportunity cost, considering potential gains from addressing defects in the old machine or using the saved amount differently. In investment cash flows, opportunity costs should be factored in by considering the potential gains or benefits that could have been obtained by choosing an alternative option, ensuring a comprehensive evaluation of the overall financial impact.
Moving on to the last question, question 4, part A. This question said you are ready to make your first investment and you have been eyeing on the three alternatives offered by Kumpulan Gemilang Sendirian Berhad. The first one is bond with a par value of RM1,000 and a coupon rate of 8.75% that are selling for RM1,314 and will be matured in 12 years. The second one, preference shares are currently paying a dividend of RM2.50 and selling for RM25.50. And the last one, the third one, ordinary shares are now selling for RM36.75. The share recently paid a RM1.32 dividend and the firm's earning per share has increased from RM1.49 to RM3.06 in the past 5 years. The firms expect to grow at the same rate for the foreseeable future. So, the required rate for this investment are 6% for the bond, 7% for the preference shares, and 50% for the ordinary shares. We move on to the first question. Based on the analysis on the information provided, which investment would you select? Provide my justifications. The solution for this question is for the bond, we need to find the I or the rate for the bond. So FV equal to 1000, which is the fair value of the bond, N equal to 12, which is the maturity date, and the coupon rate, which is the PMT paid annually, is 87.50 cent. And for the PV must be negative because we need to find the I. PV, the present value of the bond is 1,314. So using the calculator, we will get the I equal to 5.1727%. For the preference share, to know the cost of the share, we need to divide the dividend paid by the selling of the shares. So the dividend paid is RM2 ringgit 50 cent, and the shares are sold at the price of 25 ringgit 50 cent. So the percentage will be 9.804%. For the ordinary shares equal, we also get the dividend paid is 1 ringgit and 32 cent. For the expected return is 15%. So the cost of ordinary share using the formula we will get is 24.01%. So based on these three alternatives, I will select the ordinary shares capital because the expected return is the highest compared to the others like bonds and preference shares. Continue to question B. Assume kumpulan gemilang's manager expect an earning downturn and a resulting decrease in growth of 3%. How does this affect your decision in A? So, based on the first question, we calculate the number of rate for the three alternatives. So, when there is a decrease in the growth of 3%, so we need to minus all the alternative with 3%. So the new rates of the bonds will be 2.1727%. For the preference share, 6.804%, and the ordinary share will be 21.01%. So I will still choose the ordinary shares because the return still the highest compared to the others. For the last sub-question, question C, this question asks us to calculate the required rate of return that would make you indifferent to all three options. So this question is similar to the first question, which is the question A. We need to find the rate of the all alternatives. So based on the bonds, we get the I is equal to 5.1727%. For the preference share, we get the rate is 9.804%. And lastly, for the ordinary shares, we get 24.01%. Thus, the needed rate of return will be the same as in A because it is a measure of the investor's projected return based on the risk of the investment. It remains unchanged unless the investor's expectations or the investment's risk profile change.
Moving on to the question for part B. So for this question, the CFO has the planning to invest 40 million to acquire a new plant in Kuching, Sarawak. So they gave us a table of the weight of future financing for each type of financing, which will equal to 100%. And then they also stated that there are 0.5% issue cost, 4% flotation cost for preference share, and 5% flotation cost for ordinary share. And the company is under a 25% tax rate. And so this question will be related to the chapter 7, which is the cost of capital. For the first question, compute the weighted average cost of capital for kumpulan gemilang sendirian berhad. So, to compute the weighted average cost of capital, we must first compute each of the financing rate or cost. So from the information that they gave in part A, we can compute each of each of the financing. So for bonds, the present value is 1314, PMT is 87 ringgit 50 cents, the future value is 1000, the maturity is 12 years, and then we can get 5.17% for its cost of capital, but it is before tax. So in this question, it stated that they have 25% company rate, tax rate. So we have to find the cost of capital after tax, and then we will get 3.88%. So for preference shares, the information is also given in the part A for the annual dividend and the proceeds from sale. But then we have something to add, which is the flotation cost for 4%. And then after we compute, we will get 10.21% for preference shares. And then ordinary shares, we also use the formula, and then we will get 19.88%. So after that, we can compute the weighted average cost of capital by multiplying each of the cost of each of the financing with the weighted future financing that they provided in the table. So at the end, we will get the weighted average cost of capital 12.35%. So proceed to the last question, which is to explain the importance of weighted average cost of capital to the company. So it is to determine the minimum acceptable rate of return, because it serves as a benchmark for the minimum acceptable rate of return that a company should earn to satisfy its investors. Shareholders will expect a return on their equity investment that exceeds the cost of equity, and creditors expect interest payments that cover the cost of debt. It is also used as the discount rate in capital budgeting and investment analysis. So when we evaluate potential projects or investments, a company compares the expected return on the investment with the weighted average cost of capital. If the expected return is higher than the WACC, the project is considered acceptable, as it indicates the project is expected to generate returns more than the cost of capital. So that is all from us. Thank you.